Good afternoon. It's a pleasure to be moderating this session. For those that I have not met, my name is Vishal Bika, and I'm the joint head of the institutional client team with M&G Investments South Africa. ESG has been in the spotlight for some time, but what was once widely accepted is now facing growing pushback, particularly in the US. This year, more than 25 anti-ESG bills have been proposed, alongside growing scrutiny of the Biden administration's rule, which advocated for the incorporation of sustainability factors within US public pension schemes. If overturned, this could have far-reaching consequences not only for global asset managers and global companies, but most importantly for over 120 million dependent members. But the backlash isn't just limited to policy. Many are softening their language in a trend known as green hushing. We're seeing terminology change where sustainability is becoming resilience, diversity is shifting towards talent development, and the overall ESG agenda is being reframed as risk management. Meanwhile, Europe is heading in the opposite direction, raising the bar rather than stepping back. The new Corporate Sustainability Directive will apply to over 50,000 companies and aiming to restore trust through a more consistent and comparable disclosure framework. So it's clear that we're no longer operating from a single global playbook. Different regions are taking different paths, and therein lies the complexity for asset owners and investors who are looking to align purpose with performance. And this reality came through this morning in the foyer, where many of you placed your dots under regulation, a clear signal that implementation remains a challenge, even where support is strong. And that's what the session is about. How do we apply ESG in a way that's thoughtful, credible, and grounded in real investment decisions despite the noise? Now, while I may be the thorn amongst the roses, today I'm honored to be joined by three remarkable women shaping the future of responsible investment. Tembeka Stemelo Dagbo, the fund manager of the Diversity and Inclusion Fund, and also the deputy fund manager of the Positive Impact Fund at M&G. Our guest, Karen Wesley, the vice president of sustainability at Shell. Thank you, Karen. And Lucy Hancock, deputy fund manager of the Sustain and Impact team at M&G. A very warm welcome, and thank you, ladies. Let's get started. Let's start with the social pillar, which is often the most debated in ESG. We'll focus on equity and inclusion and how this drives real-world outcomes. Tembeka, sawubona njani?
Sawubona Vishal, ngibona njani?
Ngikona.
Sawubona nina nketho.
Let's begin with your journey, both personal and professional. What brought you from South Africa to the UK, and how did this path lead you to the Positive Impact team at M&G?
Yeah, I mean, it was very unexpected. I didn't really have plans to leave South Africa. I love my home, and quite frankly, I thought there were a lot of opportunities there. But ultimately, in my final 2 years of university, I did not know what I wanted to do. So I was quite intentional about the internship opportunities that I was taking on. I wanted longer internships, whether there was a job in it or not. And so I came across the Credit Suisse internship. They just opened up an office in Johannesburg, very small, 35 people pretty much across the whole firm. And they had quite a long, extensive internship program there. And so I decided to take a stab at it, and I really enjoyed it. I discovered equity research for the first time there, which was something that I did not know existed in banks. And towards the end of that program, the head of EMEA research, based in London for Credit Suisse, came to me and said, hey, we actually don't have any jobs available for graduates in Johannesburg, but I would really like you to join the London office instead. So that's essentially how I ended up here. Loved it at Credit Suisse, and then ultimately got the call, to perhaps explore M&G. I was looking at European insurance, and my manager at the time, my interviewer for this role was John William Olson, who, whilst he was the head of research at M&G, also ran sustainability strategies. And after our conversation, he was like, I want to open or launch a global positive impact strategy, which is really around investing in companies whose products and solutions are driving environmental or social impact. Would you be interested in being part of that? To me, that was 100% yes. simply because from a social impact perspective, like more specifically, I feel like I've been a beneficiary of some social impact. My whole education career, pretty much from high school, has been through scholarships, has been through, people, being able to sponsor me. And so, at least from an educational access element, I was very passionate about how transformative that could be, not only on my life, but my family's life. And so that is what drew me to the global positive strategies, impact strategies. And it's been a great entrepreneurial experience. Pretty much when we started global positive impact strategies, it was very nascent in the publicly listed equity space. At the time, there were maybe 2 other funds in the market. And so it was highly entrepreneurial. And with about 20 million pounds seed funding, we were able to grow the fund to around 3 billion pounds today. So it was teamwork, labor of love, probably worked with some of the great analysts within our teams throughout that whole process. And also gave me the opportunity to focus more on social impact through launching the Diversity and Inclusion Fund, where we can invest in diverse companies and companies who are providing social impact in emerging markets and just across the globe as well. So that pretty much is what drew me to the whole strategy. And I think, if anything, it really highlighted to me that even with all the ESG backlash that you're hearing, there's still a lot of capital going towards these strategies. There's still value add and long-term value that our clients and also the companies that we are investing in still believe in.
Okay. No, great. It'll be great to also touch a bit further on the fund shortly as well.
Absolutely.
Karen, a very warm welcome to you. Your story is equally global, from growing up in Kenya to humanitarian work with CARE, and now leading sustainability at Shell. How has this journey influenced your approach to embedding social impact and inclusion across Shell's global operations?
Yeah, thanks, and nice to be in a room with other Africans as well. Growing up in Kenya, I was there because my father was a diplomat, and then when I was 3, my parents got divorced. My mother remarried in Kenya to a Nigerian educator who'd been very active in the independence movement for countries like Ghana. So we grew up together in a mixed-race family, 7 of us kids. And Kenya is a developing country, very low levels of energy access. Many people didn't have electricity, were cooking on stoves and charcoal at home. Also, people very dependent on natural resources for their livelihoods. So agriculture was primarily what sustained people. And then, of course, the growing up in a post-colonial, quite racialized culture in a mixed-race family where I maybe had a lot of tailwinds, but my brothers and sisters had headwinds, made it really important to me to work in a company where inclusion was a core value. And I've definitely found that in Shell. Shell's aims to be one of the most inclusive organizations, has a lot of respect for people incorporated in our business principles and our core values. We have 35% of women in senior leadership, and 15% of our senior leaders identify as ethnic minorities. So the concept of inclusion was really, really important to me from a personal level. And then the factors of energy access, but how you provide more energy with less of those environmental impacts was really the core element of my interest in working in sustainability in an energy company. I'm a trained ecologist, so that's kind of interesting. There's a lot of engineers, not many ecologists. But let's get beyond the social characteristics and really think about what inclusion actually means for an energy company. And besides the personal commitments to inclusion and why it's important to me, energy is produced through large assets. There's a lot of risk in a refinery or in an oil platform. And I actually led safety for the downstream business in my last iteration of my career. And what you really want is an organization where people are empowered to speak up, where they're empowered to express the concerns that they might have, regardless of hierarchy, regardless of background, and that could save your life. So I think the idea of intervention and psychological safety is really at the core of an industrial process, and I think that's why this concept of diversity, equity, inclusion is just so much a part of how Shell operates in terms of a core value and part of the culture, and that's what allows us to keep each other safe. So that's why I think this is such a key part of our business model, such a key part of our culture, and why it's way beyond before and after any kind of political backlash to the concepts of inclusion, diversity, and equity. So that's where I see it.
Okay. I mean, it's interesting how you've both spoken about inclusion. I mean, inclusion definitely shapes thinking and culture, but it's also increasingly linked to performance, right? Perhaps, Tembeka, coming back to your fund and the fund that you manage, the M&G D&I fund, this fund makes a clear case that diversity isn't just a social good. It's a performance driver. I guess in the context of recent market volatility, how have diverse leadership teams within your portfolio contributed to resilience and long-term investment outcomes?
Yeah. I mean, I think generally when you think about diversity, equity, and inclusion, it's really about the long term, So even with some rhetoric over, 5-year administrations, companies tend to look through that and look at long-term alpha and the opportunities that exist. So actually, amidst a lot of this market volatility, the fund has actually been able to create quite significant outperformance, mainly because even still at the heart of it, a lot of these businesses are still, hyper defensible, got strong pricing powers and great moats around them. And so it's more of a commentary that you don't necessarily have to compromise merit in order to provide diversity and inclusion. Ultimately, if you've got a business model that's still resilient, that's run by diverse teams that can continue to preempt the needs of their customer bases, that on its own creates some level of resilience. So I found it very interesting that even in an economy like the US, where we're seeing a bulk of this backlash coming from, the reality is when you see some of the holdings on the fund, and even when you see some of the commentary across the board, a lot of companies are still pretty much committed to reaching diversity and inclusion. And it's because they understand the trends, especially within the US. The reality is the US is essentially going to be minority white by 2050 as a result of immigration and the significant growth in the Hispanic community. And that has driven consumption amongst ethnic minorities up by 6 times over the past 20 years. Oh. Same trends when we look at women. So 80% of the household decisions are actually being made by women in the US. And even looking at Africa, so South Africa, 60 to 70% of the consumption decisions are being made by women. Sub-Saharan Africa actually has 4 times more women entrepreneurs than Europe. And so when you think of how businesses are being led, when you think about the growing consumption power and the wealth power amongst previously underrepresented groups, it's pretty clear that in order to tap into the potential and the growth in those markets, you have to have teams that better reflect those communities that are being served. So whilst there'll be a lot of headlines from Meta and Amazon rolling back on their DEI initiatives, there's very little being said about Microsoft holding steadfast on that, Cisco. Even Apple, who hasn't necessarily had the best track record, is pretty much saying it's very important that their products and services are still being designed for the ultimate end user. And you have to have a diverse customer force workforce in order to be able to do that. And so ultimately, that's why, through the McKinsey reports where they say ethnically diverse as well as gender diverse companies tend to outperform their less diverse counterparts. Those are the trends, I think, that make it very clear as to why and why long-term value can be driven, can be provided as a result of that lens or that outlook.
Yeah. I guess, the performance lens is key, but as I'm listening to you, you're talking about inclusion. And inclusion doesn't look the same everywhere, right?
Yeah.
I guess perhaps we can explore that nuance a little bit. With transformation in South Africa, this compares very differently to DEI efforts, for example, in Europe or, for example, in North America.
Yeah.
Tembeka and Karen, perhaps if I can pose a question to each of you. From both a business and an investment perspective, how do you stay responsive to these local market dynamics while still holding together a coherent global strategy? Perhaps, Tembeka, if you want to lead, and then I can pass on to Karen.
Yeah. I think it's really about education. Ultimately, from the outside looking in, you could look at this room and say it's so diverse. Like in South Africa, we've reached transformation. We've done it, But the reality is we still have, issues with inequality. You still have 10% of the population holding 80% of the wealth. There are still dynamics there that, that show that there's still room for improvement. And that it's not just about, the easy fixes or the representation elements. It's also about, socioeconomic diversity. There's just about inclusive workplaces to help retain that diversity over the long term. And so it's not really about excluding one group from another. It's really about working together. And so the same, nuance that you need to apply to markets such as South Africa, you have to do it for every other market. It's really an education. There isn't a one-size-fits-all approach. In fact, it would be inappropriate to do something like that. So even when looking at a company such as Bidvest, for instance, a big part of its history has been solely within South Africa. And they've done a lot of work on some of the transformational efforts, primarily guided by, the ambition to have at least 45 to 50% gender or African representation across all parts of the firm. They still have room to improve, especially in middle management roles, but they've done quite a lot of work in South Africa. But now with their strategy going global, in the past 8 years, they've entered Europe, they've been in Australia, they've been in Canada. Transformation is going to look very different in those territories. And so taking that same strategy to Australia, perhaps when the indigenous population is 4%, is probably not going to be as effective. And so it's really about us as investors giving some of these management teams time to figure it out. Because it does need the time and the patience, as well as the sensitivity for these businesses to get it right. Yeah. And so you do have to offer some level of grace and also whilst holding them accountable.
Okay. Karen, perhaps from your perspective?
Yeah, I think I'll maybe take us from the company and the staff to sort of how we interact with communities around the world. We do operate in 70 different countries, so you can imagine the diversity there. And, there's a very clear relationship between the relationships you build in countries and your license to operate, your ability to actually operate safely, on time, on budget, et cetera, et cetera. So we do a lot of work on what we call social performance, which is around managing social impacts, making sure that the benefits that come from operating, such as employment, contracts, et cetera, are maximized, and any of the negative impacts are either avoided as a first step or mitigated. We also have mechanisms to get feedback, so if there's any concerns, that those are quickly understood and responded to. So I think those principles around interaction with communities are really core to actually delivering our business in a way that's on time and reducing any kind of operational upsets. And we have a lot of experiences of that. Places like China, where we ran the unconventional exploration there in an extremely population-dense area, and PetroChina did all the land acquisition. We found that when we made a rig move, it would take 60 days to reduce the community issues until we could actually start drilling. Well, we worked with PetroChina to put in place community liaison officers, the grievance mechanisms, and we wouldn't allow our general manager to sanction the rig move until we had evidence that all compensation had been paid for land impact. And suddenly, the delays went from 60 days to 2, 3, and we had very smooth operations. So just an example of why the social interaction is so important, and some of the mechanisms that you can use to make that work outside the fence line. Of course, the diversity inside being so key. You mentioned the First Nations. So in countries like Canada, we have good neighbor agreements with First Nations. We have those around, for example, our Scotford refinery, which is also very much about bringing First Nations companies into our supply chains. We do a lot of work on that. In many countries, it's also legislated, so the local content aspects are really important, and we do a lot of work to build capacity. I lived in Malaysia for 14 years, and we really built huge capacity in Malaysia in terms of the oil and gas contractor workforce. Another area is in the social investment space, such as the giving back space. There we do a lot of work on STEM education, so you've talked about the education benefits. I think we have an Explorers program that we've now reached about 120,000 people around the world on basically around innovation and science. And then we've also just launched last year with Equinor and Total an Energy Access Fund. So back to the thing, one of the things I really care about, which is $500 million to go into the business models that drive energy access in countries like, like Kenya, where I grew up, or around Southeast Asia, and use business models that are actually, commercially successful, so you can drive responses at scale, which is actually what you need. So I think those are some of the areas, working from both the license to operate all the way to what the kind of social benefits are, and the respect for communities that drives smooth operations and performance.
Okay, that's very interesting. And I think, I mean, perhaps if we could maybe take a step back and widen the lens a little bit more on ESG, and perhaps turn to another area under equal pressure from a global perspective, the climate transition. And Lucy, perhaps I could bring you in here. Alignment with the Paris Agreement is often misunderstood.
Yep.
Many investors, in engaging, misunderstand this and think it means exclusions or sacrificing returns. But your fund, the Global Sustained Paris Aligned Fund, takes a different approach. Can you perhaps walk us through how this practically plays out, within your portfolio, and in terms of portfolio construction, how this works?
Sure. Well, thanks, Vishal, and thanks for having me here on the panel, and welcome to everyone here. As Vishal mentioned, I'm a deputy manager on our global and European sustain funds, which are Paris-aligned, Article 9, and now SDR labelled funds. I'll go through the fund construction, the investment proposition as well, because obviously that's key. So the fund itself really has a dual mandate. So it has the investment mandate to outperform the market over a rolling 5-year period, and also a sustainable objective, which is to invest in companies which contribute to the Paris Climate Agreement. So from an investment point of view, first of all, we don't see the sustainability objective in any way compromising the returns that we target to generate. So that's a key thing that, I think, as you mentioned, a lot of investors, maybe think that that's what you have to do, but certainly we don't see that as a choice between the two options. And so from an investment point of view, really the focus is to invest in high quality companies that can compound earnings over a long period of time, and also companies that are very sustainable in terms of their business model and have defensible earnings. And then on the sustainability side, when we're constructing to think about an alignment with Paris, we essentially segment the companies into low-emitting and also high-emitting companies. We can invest in high-emitting companies. We do have some exclusions actually on the fund, but they are, we can invest in higher-emitting companies. With the higher-emitting companies, what we want to see, though, is those climate emissions targets in place. And the framework that we use is the Science Based Targets Initiative. So we have to have those high-emitting companies have to be signed up and committed to emissions reduction targets from that organisation. We can also then invest in low-emitting companies which don't have carbon emissions targets, but we would look to engage with those companies in order to get those emissions targets in place. And we have a very well-developed, well-structured engagement program where we bring companies through the engagement chain from, first of all, disclosure, which actually on our portfolio is now very rare. I think there's only one company, all the way through to committing to setting targets, actually setting those targets, and then finally onto monitoring their performance against their targets. So that's how we sort of put the companies in terms of their emissions targets. And then in terms of portfolio construction, now if you think about just going back to what the Paris Climate Agreement is, obviously it's to be well below 2 degrees, but ideally 1.5 degrees, and that equates to a 7% reduction per year in in carbon emissions. Now, from a portfolio level, you could essentially achieve that by just selling your holdings or reducing your holdings every year, high-emitting holdings, in order to get a number that essentially reduces by 7% every year. But from our point of view, we don't see that actually achieves anything. So by reducing that company, you're not actually affecting real-world outcomes. So what we're trying to do is we're trying to get each individual holding to reduce its emissions by 7% every year and following the Paris Agreement. So we do that, again, as I mentioned, through an engagement process, so a very thorough and strict engagement process where we go on to monitor these companies to make sure that we do that. And then one thing that I would sort of add, which is sort of quite unique about our portfolio and our investment approach, which allows us to do this, is we have a very long holding period. It's quite unique. I mean, it's 9 years on average, which is extremely long. And, only funds that are that patient can really sort of go through that engagement chain and stick with companies until they achieve those carbon reductions, because we're fully aware that a carbon reduction profile of a company, whether that's low or high emitting, is never going to be a straight line. It will be it will have its variations. Obviously, carbon emissions, as we were talking about earlier, linked to growth, and whether that's developed economies or emerging economies, these companies have to grow. We expect them to grow. We want them to grow earnings, but we also expect them to reduce emissions at the same time. So that is quite a challenge, and we expect that path to not be straight, and hence why our long holding period really helps us to sort of stick with that path.
I guess over the past 18 months, you've, beyond regulatory pushback and political pushback as well, and the evolving regulation, you've also been faced with the clean tech boom and bust cycle as well. How are you and the team maintaining clarity and conviction with clients through this period?
So I think there's probably two elements that we've seen. The clean tech sort of boom and bust, I would like to call it. I think that was maybe a bit earlier. But let's start first of all with the ESG backlash, I guess, the topic. And you mentioned a few aspects, but just to set the scene around regulation. So the CSDR reporting regulation for European companies is an important regulation in Europe, which has helped us actually get a couple of companies to commit to disclosing their emissions, particularly low-emitting companies. But that's actually a regulation that has been pushed back. It's not been withdrawn, it's not been walked back, but it has been pushed back from a time frame point of view, and it's potential that regulation is going to reduce in scope. So it's actually going to be potentially applied to companies with only above 1,000 employees and above 450 million in turnover. So that is, for me, we don't actually see that as a turnaround. That is a sort of softening and perhaps a practicality around the regulation. So it's not a turnaround. It really is still something that's at the forefront. And also, as we mentioned, the UK SDR regulation for sustainable funds, we've gone through that process, which was a very thorough process. The UK, we've remained committed to that. So that's still happening. Obviously, the US is something it's a different environment. The rhetoric is obviously very different, and concretely the SEC has walked away from requiring disclosures for companies, which again obviously could be a challenge for us. But I noticed recently there was some research produced by an executive compensation consultancy saying that actually in the US they surveyed 50 of the biggest US companies, and 71% are still maintaining their climate goals, and in fact 8% are actually increasing them. So there are still a large number of stakeholders in the US that are committed to this. And I would say from our point of view, we don't actually see any change. We don't see any pushback. The level of engagement that we have with our companies has not changed. So that is, we still see it as something that is happening. And second of all, we set up the fund with the commitment to benefit all stakeholders, our investors, and also the planet. And that problem is not changing. We don't see that. Obviously, that issue isn't changing. So we're not walking away, essentially, from that commitment.
Okay.
Can I just add to that, actually? Yeah. On the positive impact strategy, we do also invest, obviously, in environmental efficient names. And the reality is we want there to be a proper link between the business model and the actual impact that's being generated. And there is not just energy efficiency when it comes to looking at alternative energy, but also a cost efficiency element. And that's probably something that remains pretty well intact, even in this climate. Yes. And so you won't see people as readily walking away from those targets. As well, like these American companies are still very much global. So over, 20 to 50%, depending on which company, of their earnings are coming from Europe, outside of, the US. So even European regulation still becomes something that they have to anchor towards. So they might not come out with a flashy sustainability report, but they'll do CSRD reporting, which will still provide some level of transparency. So I think there are still influences from outside of the US that's also helping to ensure that pipeline and the watch list on some of our funds remain pretty solid and investable opportunities in the long term.
I mean, it's very interesting. And I mean, speaking of opportunity, perhaps, Karen, we can shift to you. I mean, Shell's traditionally known as a major oil and gas player, but you're now investing heavily in the energy transition, from hydrogen to EVs to carbon capture as well. Perhaps you can shed some light on what's the commercial case behind these moves and which technologies, from a Shell's perspective, you see as the most competitive, and staying ahead of your capital allocation strategy.
Yeah, sure. And thanks a lot for those good introductions. Shell's been on the energy transition journey like everybody, and had some stops and starts based on all these market moves. I think I made some examples earlier on about how some of these sustainability elements are core to our practices and values. So let me switch now more to strategy, where our strategy is to have more value and less emissions, right? So that's actually integrated into our strategy, and the sustainability is how we do that through how we support nature and people through the energy transition. So that's very much a part of our core strategy. In terms of the disclosures, we actually have disclosed on CSRD. I did want to say what's interesting about that is the double materiality assessment that tells you, where do you have an impact on environment and people, and where then do you have, how does that impact your financials? So this double materiality lens really allows you to really focus in on what are the key sustainability elements that are most material, and of course climate is one of those. In terms of the targets, we do have 4 climate targets that are linked to our strategy of more value and less emissions, starting with the reducing your Scope 1 and 2 emissions. So that would be around Scope 1 and 2 reductions of 50% by 2030. We're a 30% reduction now, so 60% along the journey. On methane reductions, we've reduced by 76% against the baseline of 2016. That was a really intensive effort because of the global warming potential of methane, how important it is to get on top of those emissions, and because it's a value accretive product. Methane is something you want to sell, so there's all kinds of reasons why not leaking and not flaring makes sense from a business perspective. In terms of the transition itself, we have been consistently investing in low energy solutions, low carbon solutions across a whole range of areas. Adjacent to our strategy in terms of liquids. So biofuels, of course, is a big component with the zero Scope 3 emissions. We've invested in various types of renewable energies. We also quite heavily invested in LNG, as you know, as a 50% less carbon than coal. So that's another piece of the story. And then also in the sense of removals, because it's clear that getting to net zero requires also decarbonization and removals. So we invest quite significantly in CCS. In fact, we've just taken 2 FIDs on CCS in the US, in Canada, at our Scotford refinery, where we've sequestered 9 million tons of CO2. And we've also just taken a very interesting move in Norway. I don't know if you've seen it, but we're shipping CO2 now from industrial emissions into offshore fields in the Sleipner field in Norway. So that's also with about a 5 million MTPA reduction capacity per year. So those are just some of the things, starting from how you decarbonize your existing value chain, how you invest in the adjacent low carbon solutions, and then of course how you invest in the removals themselves. So we've invested in the last 2 years $8 billion in low carbon solutions. That's well on track with our 13 to 15 billion between 2023 and 2025. And we keep looking for places which meet our belief system, which is one, that the energy system is an important part of prosperity, that it needs to transition, but in a way that's profitable and returns to the investor as it returns on the emissions reductions. And those are the types of opportunities that we continue to look for as we invest. We also invest significantly in R&D. So half of our R&D spend, $500 million a year, is on low carbon technology and solutions. So that's another area where you're preparing for the future as well.
Okay. I think that's very interesting. I mean, I'm just looking at the counters. I'm just conscious of time, but perhaps one last question for you, Karen, is you engage quite actively with investors. Recently you've engaged, with the World Business Council, engaging investors. What's resonated most for you, through these engagements, and how have you incorporated, if ever, how do you incorporate this feedback, into shaping Shell's strategy? Do you have any examples for us?
Yeah, no, good question. Shell's been a founding member of the World Business Council for Sustainable Development since 1992, actually. And I was just at the launch on Monday of the Business Barometer, which said that 91% of CEOs still believe in sustainability as a really strong driver of both resilience and competitiveness. So that was an interesting number just to share. I've got a wonderful colleague here, Oswald, who works in our investor relations area, and Shell takes its board and EC, to meet with investors around the world. We're deeply curious about the investors' views on how we operate and taking those views into our strategic thinking. We love energy, so we love to talk about the energy and the energy transition, and we're heavily invested in making it successful, both for Shell, of course, but for the planet, which is what I care about. I'm also on the board of IPECA, which is the Energy Association, and there we've really been looking at, as we transition as a sector, how do we bring the good practices on social and environmental into the new space. So I've set up an alternative energies task force at IPECA, where we're looking at circularity of windmills. We're looking at life cycle assessment of solar and how you ensure that you actually are decarbonizing while you're investing in low carbon solutions. We've also been looking at the environmental impacts of CCS. So the point is there that decarbonization also brings other impacts. It's positive for climate, but there's other things you need to manage around social transition and around environment. So we're really working hard to integrate that into some of our associations, because whereas 13% of emissions come from international oil companies, 87% come from national oil companies. So interacting with these associations is a way to bring the whole industry forward on the decarbonization journey that will take us to those aspirations that you described.
Okay. Perhaps if we could just pause there, perhaps there's time for maybe one quick question from the audience, one or two quick questions from the audience. Are we going to use the mics, I think, in the seat pockets, if there are any questions for the panelists? Over here.
Thanks. Any thoughts? I know this is probably quite specialist, but any thoughts on around green hydrogen? Potentially, that could be a massive opportunity for Namibia and South Africa over the long term. Is it still very early stages around that in terms of a viable transition fuel? And then I'm just interested in your, just MNG and Shell, whether you are walking back some of your proposals. What are you doing in response to the backlash?
On green hydrogen. I mean, I think it's probably a different market to what it was previously. I think green hydrogen was always probably going to be a costly endeavor. It's a new technology, relatively new in terms of the cost, and quite high on the cost curve. So I think, probably it's going to take quite a while for that technology to really be cost efficient. If we look at companies that we own, for example, Linde, they really see the short-term and medium-term opportunity in blue hydrogen, and that's where they've been focusing their efforts. Green hydrogen for them is more of a longer-term opportunity. So I think really, you need the economics to work. And then I think obviously in the US, we've had subsidies being pulled away from that. And so, that really changes the economics for green hydrogen. So it's probably something that I would see as a longer dated opportunity. And there are various challenges obviously around getting the electricity. So you're really losing energy along the conversion chain. There's lots of projects which involve sort of moving green hydrogen, which may not be the most efficient way. There may be other solutions. But yes, so I think it's probably not going to be the first technology that will be adopted. Karen, I don't know if you've got any.
Yeah, no, we have invested in hydrogen, in green hydrogen in Europe, and we have discussed with investors sort of the tepid markets around this and the dilemmas that creates for us. And one advantage is that we can be an anchor customer for green hydrogen. So where you can create a green hydrogen capability adjacent to one of our refineries, for example, that's an opportunity where there aren't so many other clear market signals. So those are some of the dilemmas that we're facing in that space.
Mm-hmm. And I guess on whether we've been walking back any ESG, no. I think even in our department, probably the greatest flow in AUM has actually come from pension funds wanting, options from an investment perspective, whether it's in environmental efficient funds or social funds or both, and more broadly, it's when it comes to ESG, it's not necessarily been a nice to have. It's been seen as structurally necessary. Especially within the UK, where ultimately about 60% of the UK's wealth is going to be held by women by the end of this year. And that's because you have the baby boomers, essentially, baby boomers, unfortunately, passing on, and men, unfortunately, go before women. And so from that perspective, there's basically a structural change in our investee base. And ultimately, about 70% of funds, when they're changed by women, the woman actually changes the asset manager. So there are a lot of opportunities that come with that. And it really highlights that, as far as diversity is concerned, it's not really just about having a kumbaya effect. There are structural benefits to it. M&G has pretty much held steadfast even on its targets. So it wants to reach 40% gender diversity at senior leadership positions, which it already has, and has pushed that to 45%. And also ethnic minority representation, they want to reach around 20%. We still do pay gap reporting. And so that level of transparency and commitment still remains, given just what our clients want, and also the fact that it's just the right thing to do.
And then just to add, from an M&G level, we're maintaining our carbon emissions target to be net zero by 2050. So we're not walking away from that.
No, thank you. Thank you so much, ladies. We are unfortunately out of time, but if there are further questions, we are all around and we can definitely engage over lunch. So thank you so much to our panelists and to the audience. I'm now going to hand over to Anne Lepile, who's going to lead the session on public and private markets. Thank you very much.